thank you for joining today's webinar that is titled Navigating the New Tax Act, focusing on strategic insights for investors and high-growth businesses. My name is Morayo, and the essence of this webinar is majorly to educate our clients and our participants at large on how this new tax reform would impact their businesses, their investments, and even their personal finances as a whole. On 26 June 2025, President Bola Ahmed Tinubu signed 4 tax reform bills into law. The enacted tax reforms include the Nigerian Tax Act, the Nigerian Tax Administration Act, the Nigerian Revenue Service Act, and the Joint Revenue Board Act, collectively referred to as the Act. The Act comprehensively overhauled Nigeria's tax landscape to drive economic growth, increase revenue generation, improve the business environment, and enhance effective tax administration across all levels of government. So with me today are two high-level tax consultants in the industry, and I'm sure that this webinar is going to be very impactful. Allow me to welcome our Deputy Group GMD. Her name is Mrs. Mubo Olashoko. She's going to be giving us the opening remarks.
Thank you very much, Mariah. Good morning, distinguished investors, partners, and colleagues. It's my pleasure to warmly welcome you, to this very important webinar on navigating the new Tax Act. As an investment firm, we know that these new changes will create a lot of uncertainties and will raise critical questions in the mind of investors, whether you're a retail investor or institutional investors. And the purpose and objective of this webinar today is one, to demystify the new tax provisions so that everyone can feel comfortable, know what their responsibilities are, what their compliance responsibilities should be, and then also to provide insights and strategies into how you can better manage your investments, even as you earn, as you invest, and as you exit the market, and as you restructure your portfolio. So, as Mariah has said, we have new tax acts. We have experts this morning, to walk us through. And in walking us through this morning, we'll be looking at the new capital gain tax, the revised one. We had one before, but this has been revised. We'll also be looking at withholding taxes on interest income and the likes of them. So I just want to invite you to say that you have a lot to learn in terms of knowledge, insight, and tools that can be used, going into 2026 to maximize your investment and to also ensure that you get the best out of your investment. So thank you for joining us again this morning. I welcome you to engage, ask questions, and be blessed as you listen. Thank you.
Thank you very much, DGMD. Thank you for your introduction. And allow me to introduce to you our speakers. Our first speaker for today, we have Mr. Albert Folorunsho. Mr. Albert Folorunsho is the managing consultant of Creston Pedabo. He started his professional career as an accountant with National Commission for Museums and Monuments in 1988. Before joining the firm of Babington, Ashai & Co. in 1992. He has been involved in all aspects of taxation practice, varying from international tax advisory, transfer pricing planning and implementation, oil and gas taxation management, to name but a few. He has also handled several insolvency assignments for financial institutions ranging from debt recovery, liquidation, and receivership management. Mr. Albert is a managing consultant of the firm Preston Kadabo, which he co-founded in 1998. He's a fellow of the Institute of Chartered Accountants of Nigeria with over 29 years of professional experience in taxation insolvency practice, and management consulting. He is also a fellow of the Chartered Institute of Taxation of Nigeria, CITN, an associate member of the Chartered Institute of Bankers of Nigeria, CIBN, and a member of the Business Recovery and Insolvency Practitioners Association of Nigeria. He is a member of both the Working Group on VAIDS implementation in Nigeria and Tax Advisory Committee to the Tax Appeal Tribunal. He holds a Bachelor of Science degree in Business Administration from Ambrose Ali University, Epuma, and a Master's of Science degree in Banking and Finance from University of Ibadan. He also holds a Bachelor of Laws from University of Essex, England. Once again, join me to welcome Mr. Albert Folorunsho.
Thank you very much.
Good morning, sir, and thank you for joining us to speak to our audience on this new tax reform.
Thank you.
So we know that this is a reform. What has changed? Where were we before? And what is coming into play now? Can you introduce us to the new tax reform, sir?
Okay, thank you very much once again, Maristem, for putting this together. A lot of firms have done this, and I think it's high time that the public gets familiar with the law. Yes, we used to have several taxes, provisions of the law, but the main focus of this reform is to streamline and repackage and refocus the provision of the law, and more or less put together, more or less synchronize all of those provisions that were in bits and pieces. Again, there are several of those provisions that have been with us for some time. The essence is to make them to be up to date and to align with current business realities that we face as a country. So therefore, those laws have been put together in 4 buckets. We have the Nigerian Tax Act, which is the main taxing provision that contains, all of the taxing acts that used to be in pieces. For example, the personal income tax, the company income tax, the capital gains tax, the Stamp Duties Act. All of those are now under the Nigerian Tax Act. Then we have the Nigerian Tax Administration Act, which is the administrative arm of the provision that determines the type of returns you file, who you file with, when do you file, what type of technology can be deployed, what penalties do you face if you fail to file, what type of investigation and review that can be carried out by the tax authority. All of those are contained in the Nigerian Tax Administration Act. Then we have the one that is replacing the FRS, which we call the Nigerian Revenue, the NRS, Nigerian Revenue Service Act, okay, that outline the functions and responsibility of the current Federal Inland Revenue Service, and to also specify what role they have to play, particularly when it comes to company. Then the last one is the Nigerian Revenue Board Act, which is more or less replacing the Joint Tax Board. Okay, but of course, that specifically covers all of the taxing authorities, including the State Internal Revenue Service, the Local Government Revenue Service, and make provision for appeal procedure, going through the tax appeal tribunal, the introduction of the tax ombud, and all other responsibility around, other authorities are contained in the Tax Admin Act. So that's what we have. And in terms of an overview, if you want me to continue,
Yes, sir.
yes, I will say that specifically changes have been made to most of the laws. The personal income tax has been amended significantly to recognize majorly those who are low-income earners. And what I can summarize to say that if you are a low-income earner up to 20 million a year, the impact of this law is that your tax is coming down. But if you earn above 20 million, the implication is that, as a progressive tax system, your tax may be on the increase. Some of the relief that used to be available have been removed, but replaced with the zero rate for the first band of if the taxable income is not more than 800,000 a year. All right, that is for personal income tax, amongst other provisions. When you come to companies' rate remains, unfortunately, 30%, even though there are provisions in the law that says that that can reduce to about 25, which can be triggered by the government. And again, capital gains tax, which has been the very controversial addition, is the fact that that has also been, harmonized with the corporate tax, which means that the rate at which companies pay capital gain tax now is no longer 10%, but the corporate tax rate, which is currently 30%, hopefully will come down to 25%, and hopefully some amendment will be made. While for individuals, when it comes to capital gains tax, the applicable rate, again, is determined by the individual tax rate. I mean, depending on your income bracket, your rate is determined by where you fall on the graduated tax table of rate. Those are significant changes. I've also heard about the fact that the exemptions, particularly for certain income and deposit, foreign currency deposit, interbank deposit, deduction at source, and all that, so many changes have been made. And some of these changes are triggered by the fact that what is going on globally. The OECD has been working on ensuring or hoping that the developed or developing countries, will save some tax by reducing base erosion and profit shifting. And so they have proposed under the inclusive framework, a provision that ensures that the source of income, has the privilege of getting some level of minimum tax to that country where the source is. And that is what introduced the global minimum tax, which is applicable to multinationals group with a group turnover of no less than 750 million euro a year. And every company that is a member of that multinational group is expected to pay at least 15% tax, 50% of profit before tax, on their profit. And where that tax is not paid to the source country, then the home country of the multinational have the right to subject, such a company that have a subsidiary in their own territory to such tax. So that really has been the main support for the rise in rate that we are likely to experience coming into 2026, because we don't want tax that are due to Nigeria to be ceded to other countries. But of course, we have our own peculiarities. But I'm sure we'll take more details. We'll look at some more details.
Thank you.
In coming questions.
Thank you so much, sir. Thank you for that insightful overview. And I'm going to introduce our audience to the second speaker. I mentioned to you that we have two powerful speakers on today's webinar. Our second speaker, we have Ms. Esiri Agbeyi, who is a partner at PwC and also serves as a family business leader for the Africa region. She heads the private wealth and family business team within the tax practice. She previously worked at PwC in New York and has a strong track record in international tax, cross-border restructuring, deferred taxes, holding companies, and regional hub structuring. Her industry experience spans oil and gas, power and utilities, manufacturing, FMCG, and private equity. She holds a BSc in microbiology from the University of Ibadan and multiple professional accreditations, which includes Fellow of ACCA, Chartered Institute of Taxation of Nigeria, Institute of Chartered Accountants of Nigeria, and she also holds professional certifications in private equity from the London Business School, Sustainability and Circular Economy from Cambridge George Business School, and International Tax from the NYU. Allow me to welcome to this webinar Ms. Esiri Agbeyi.
Thank you very much, Mariah. I'm really excited to be here, and I hope I'm very audible. It's also a pleasure to be on the same panel with my colleague in the industry, Professor, as he likes to be called. All right.
Thank you. Thank you very much, Asiri. Okay, so we'll just delve right into it. So we've gotten an overview on what are the changes in line with this new tax reform. So Asiri, can you walk us through what are the exceptions? It's not, this tax reform is not a guillotine, right? What are the exceptions in this tax reform? Where do the general public, how do they benefit from this new tax reform? Can you walk us through that?
Okay, so I'll try and answer. I think broader context would have been nice because when we say exceptions, the exceptions may differ depending on the particular circumstance. But I think generally where the tax reform is headed really is to align us with international practice. And it's also institutes some sort of discipline, but also comes with rewards. So to the extent that there is financial discipline exhibited in certain instances, or you're corporatizing activities, you then get some incentives or rewards in that sense. What it also does is it raises a lot of guardrails, and it does that through a penalty regime, a stricter penalty regime. So to the extent that you're not compliant in certain instances, you might find yourself compliant. So when you weigh those together, it's like a carrot stick approach. And so the exceptions really can be found with the carrots that are being dangled, and how quickly people can take advantage of those. And I'll give examples as well. So if we look at the fact that the threshold for exemption for individuals is way lower than what you have for corporates, you'd find that the sense is we do need a lot of our taxpayers in the tax bracket, but also at the corporate level. And the exemption for companies is about 50 million in terms of your annual turnover. So businesses that generate that kind of turnover and below are exempt from taxes. Whereas when you look at the individuals, the highest threshold for exemption is about 800,000 naira. And that also applies to registered businesses. So you'd see that very clearly. If you were a company, then it's better off. The second thing is around also capital gains tax. You know, some of the conversations I've been part of and I've listened to seems to suggest that maybe the government is looking at promoting more investment on the short term, because it feels like, you know, the taxes have increased, and therefore they're looking for short-term needs. But I dare say that, you know, the exception really is in a long-term play. And you see that also in the exemptions that are available when you invest in equities. So to the extent that you reinvest the proceeds in shares, even when you disposed of them, when you do reinvest those proceeds, they are exempt. There's also a higher band in terms of the threshold for exemption. For instance, you have now 100 million and being exempt. But in addition to that, if you do have capital gains of a certain extent, you may also be exempt from that tax as well. So in terms of short-term play, you know, it kind of reduces the bar to then specify thresholds. But for the longer term, if you reinvest all of those proceeds, you find that it's stretching it a bit wider to say we want a long-term stay of funds. I think the other thing is also around governance. So this reform is really big on governance, and in that sense, it does so by identifying the fact that when you have a tax planning arrangement, you now have to disclose it. So this is requiring a lot of attention from board members and members of boards to pay attention to strategic investments by companies, and as they deploy those as well, to make sure that they are also tax compliant, but also transparent. And because this regime is also looking into tapping into the wealth of resources we have globally, to say we can exchange information and get more information, not only internally within the country amongst agencies, but also externally with other countries. And then two, what we're also seeing is there's going to be a lot more emphasis on substance of activities. So to the extent that those activities are substantial, and in that sense, we want to see that there is a lot of activity from people employed where you do investments outside, that because of that substance, you can then enjoy the tax regime in those jurisdictions. And in the absence of those substance, those investments will be looked at as artificial. And then there are several clauses on how Nigeria can then take back those returns on the investment and tax them in country by way of different rules like the CFC rules, but also the deemed dividend rule. So I'll stop there. I think the exceptions are varied depending on if you're an individual or a corporate. And the important thing really is to pay attention to what the law requires, to also avoid penalties, because those exceptions can also mean that because you don't even have those penalties to deal with, you are then having an upper hand with the government. And I think also maybe to just throw in there is the big change that we now have with VAT, where you can recover a lot more in terms of the VAT that you saw. So the profits that hidden away because of the VAT that they couldn't recover. But even if they do have more profits, there is some tax that they do need to pay at 34%. But it's better off than not even having that profit even reported in the books at all. So I think with the big change that we have in VAT, there's a lot more in terms of profits that companies can avail themselves to. And that in turn becomes something that goes back to shareholders, because dividends will be reported from those profits as well. And hopefully, as we start to stabilize into the tax reform, we might see the effect of inflation going down, more profits reported by companies, and then a more robust tax regime that can support the infrastructure growth that's required for the country.
Okay. Thank you very much, Esiri. Thank you for that very detailed explanation as to where, the general public could also benefit from the new tax reform. Going into the new year, we've had a lot of investors, a lot of our clients asking, capital gains tax, what's going to happen to my portfolio? We've gotten, some G3 sell mandates, especially in the equity space. So, sir, can you tell us exactly the capital gains tax and the impact on equities investment? Let's bring it there first. We know that when you reinvest your proceeds, you're not subjected to the capital gains tax. However, at the time you're exiting your reinvestment, does the initial gains tax apply, or it is just going to be on the fresh investment? And I know that there's a band of up to 150 million, right? It is when you generate that turnover that the capital gains tax takes effect. Or is it at the point where you sell and you want to take out your funds? Please help us dissect the capital gains tax.
Okay. Dissect the capital gains tax as it relates to shares.
Yes, sir. Yes.
Okay. So capital gain, as it is when you dispose what is called chargeable assets, and you make chargeable gain from such disposal, then you are liable to capital gain. One of the chargeable assets is investment in shares and securities, all form of securities and shares. And the current provision, I mean, that applies up to 31st December this year, is that when you make a gain, I mean, gain is your sales proceed less your cost. And the cost include the cost of selling as well as the full cost of acquisition of that asset. Then you take it out from your proceed. If you make a gain, you pay tax on the gain at the rate of 10% currently. If you make a loss, the loss is available for deduction from your subsequent years gain if you make a loss, and that provision still remains. So, but the new introduction to in the incoming law, which is starting from 1st of January, is that for as far as shares are concerned, capital gain will only apply if the sales proceed is not less than 150 million. That is above 150 million, the proceed of sale. Okay, if it is above 150 million, which means if your proceed is below 150 million, capital gains tax does not apply. However, even if the proceed is less than 150 million and you make a gain that is above 10 million, CGT may be triggered at that point. So that is the first point. And so small dealers, small operators or workers that have small money to invest, they shouldn't be worried about capital gains, I mean, on their shares, okay? Because looking at that bracket, they're exempt. Again, if you sell your shares and you reinvest within the year of assessment, for tax purposes, year of assessment is always January to December, okay? If you sell and reinvest within the year of assessment, the gain on that disposal does not apply, which means it's exempt because, I mean, you are supposed to pay tax, but you have used the money to buy shares and remain in the market. Where is the money to pay tax coming from? So the law says, as long as you sell and you reinvest within the year of assessment, capital gains tax does not apply, regardless of the quantum. That is the current provision. Now, if you are not within those exemptions, the capital gains tax rate, now, which I mentioned earlier, has been aligned, okay, with the income tax rate, which means for individual, it is the income tax rate that applies to the gain if the volume is above that. For companies, it is the company tax rate. And we know that the company tax rate, as proposed in the law, is 30%, which can be reduced to 25%. While for individuals, the tax bracket ranges from 0%, so which means if you make a gain that is less than 800,000, CGT does not apply. Okay, but I mean, depending on your tax bracket, the rate is 0%, the next 2.2, 15%, the next 9 million, 18%, the next 13 million, 21%, the next 25 million, 23%. When you now sell, when your income is above 50 million, then 25%. Okay, so the rate applies in that manner. So, but because of the agitation, a lot of things are being thought out, particularly as to you also as to what can mitigate, all of this gain. One is the first one that you mentioned, that if you sell and then reinvest and then sell later, what happened to the gain?
Initial gains.
The gain is free. Okay, if under a proper rollover relief, when you sell and then reinvest and then subsequently go sell without investment, all the gain that has accumulated before should ordinarily be liable to tax.
Yes.
That was the old capital gain. With this new one, that is applicable only to shares, when you dispose of your shares and you reinvest, the gain from the initial disposal escape tax completely. And that is why we notice that some people are trying to sell now
Yes.
so that they can reinvest. And then when they reinvest before the year end, the original cost no longer have a role to play. It is the cost of acquisition, reacquisition that comes into play.
Down from the base cost.
The base that form the base cost. The old cost is no longer applicable. Okay, I'm sure that is also different from what applies in the UK, where that base cost is brought in and then the gain that you rolled over before become taxable. In this case, the gain rolled over, no gain is rolled over. You determine a new gain from your new sales proceed less your old, your earliest cost. Your latest cost. Okay, which is a very big plus. Again, there has been conversation as to the cost that should be considered. A lot of cost can be said to be related to the acquisition of shares. For example, if you take a margin loan to acquire shares, under the current provision, that is really not deductible. But with the unification of the rate with other income tax, it doesn't really make any difference if you are allowed to take those deductions. So which means it may be possible to take deduction for the related cost of borrowing that you use in raising funds to invest, which is huge as far as I'm concerned. Another item is the fact that a lot of people that bring in foreign exchange to buy shares in our market, they can be making gain in Naira, but truly serious loss, depending on how the Naira moves. The exchange move. So you can have serious loss in your investment if it is done in foreign currency. But in Naira, you can be seeing gain, which is artificial. So it is expected that will also be considered going forward, okay, under this new provision. Since you are harmonizing gain and income, you cannot throw any expense anywhere. They are all under the same purview as far as I'm concerned. So therefore, such deduction should be allowed. I'm also hearing that it is possible to do, if we look at the new law saying that the law is starting from 1st of January, which means it is only the real gain after December 2025 that should be liable to the new law, which means there should be some element of grandfathering to the extent that we should be looking at the value of the investment as at December, and it is only the increase above that should be taxed. To be fair, really, because we don't have provisions in our law that shield inflationary gain from tax, which we call indexation allowance that you have in other jurisdictions. So all of these are things that are being considered so that the fear as to eroding people's gain will be reduced. So that is the picture, and that is what we expect will make the public to have some confidence in the market and continue with their investment in securities and equities. And again, this is not only applicable to trading on the capital in the Nigerian exchange. It also includes private equities. Okay. So the same provision apply. All right. Whether you sell in the capital market, it's a private asset investment.
Oh, thank you very much. So, follow up to that question, I want to ask: we have millions of traders in Nigeria. Equity traders.
Okay.
Now that we have technology that has allowed investors to be able to trade from the comfort of their different locations, for example, the Ameritrade, who bears the responsibility of filing this tax?
Okay. So let me start with corporate first.
Okay.
So that is more straightforward. As a company that is investing in shares and selling the shares, what the provision have said is that you file the return like your normal income. Okay. Under the current provision, that applies up to 31st December. Companies are allowed to file capital gains tax return twice a year.
Okay.
Okay, so that you don't keep the money for the whole year. If you sell in the first quarter or second quarter, by June, you should be filing the return and paying the CGT. And then subsequent sale, by the second. But with this new provision that now synchronize or aligns corporate tax to, income tax to capital gain and all that, you are required to file your capital gain tax return just as you are filing your income tax returns, which means all your transactions in 2025 for companies will be filed in 2026 by June. As you are calculating your income tax
For the year.
you are also calculating your capital gain for the year and then paying needs based on the provision of the law. Okay, and if something you want to ask for installmental payment, just like we have for company, you can start from January next year and start paying until you even file your return. And subsequently, if the tax authority allow, that is for company. And it is all going to be obvious in your financial statement. We'll see your investment, we'll see the disposal, you see the acquisition, and it is very clear for company. And of course, every transaction in this exchange can be viewed and can be captured. CSCS will have details. So going to individual, that is where I believe guideline has not come out as to how it will be applied, particularly for individuals that are going to be filing with state, because gain made by individuals on disposal of shares are also payable to the state where they are resident. It's not corporate tax, it's not to the company, it's not to Nigerian Revenue Service or Federal Revenue Service. Okay, so I'm sure a guideline will be out, and I believe that a source deduction is not in the law. I'm just thinking aloud. A source deduction that will involve the way stamp duty is being captured by CSCS now may be something that the tax authority will be recommending going forward. But that has not been put out. But I suspect something like that may be in the offing.
Because that way it makes the process a lot tidier.
And then you don't even know, you just get your money.
And then there's transparency as well.
Yes, the conversation is also the same thing that is on relating to treasury bill and all that. Maybe we'll get to that.
Thank you very much. So let's go to Esiri. Esiri, you're still with us?
Yes, I'm here.
All right. Thank you very much. Okay, so we're getting a lot of questions from our live audience, and we also have some questions that have been collated across the Meristem group. So I'm going to have you field one of our questions from Meristem Trustees Limited. So this is our business unit that handles all of our trust requirements for investors. So I have, what are the circumstances under which capital gains tax will apply to Meristem Trustees Limited in its capacity as trustee or nominee, as well as settlers and beneficiaries of both local and offshore trusts? So do you want me to take the question again, Esiri?
Yeah, please.
Okay, so what are the circumstances under which capital gains tax will apply to Meristem Trustees Limited in its capacity as trustees or nominee, as well as settlers and beneficiaries of both local and offshore trusts?
Yeah. So I think the trust taxation largely remains the same, save for the introduction of the residence rules, which we never had before. So now we have a residence definition that clearly distinguishes between those who are local Nigerian residents and those who are non-residents in Nigeria. The residents in Nigeria pay taxes on their worldwide income. Okay? Non-residents will only pay taxes on their Nigerian sourced income. So when we then come to the conversation around trust, you then want to ask, is a foreign trust or an offshore trust resident in Nigeria, or is it non-resident? Is the local trust resident, and as it is resident, who pays the taxes? That's where you then start to need to identify where control is exercised where the beneficiaries of the trust, including the settlers, are resident as well, who exercises those control, and then you come to the conclusion on whether they need to pay taxes on their worldwide earnings or need to pay taxes on their Nigerian sourced income. So it's almost like a tree that you go through. Now, when you think about a trust structure that has a settler that still exercises control, and that will typically be a revocable trust, and the settler has a lot more control, under the Tax Act, you will then need to file returns and account for taxes in the name of the settler. In addition to that, you want to ask yourself, where is that settler resident? So imagine a scenario where you had a local trust structure for holding local assets. You had an offshore trust structure for holding offshore assets. And for the benefit of the audience as well, I can simplify the conversation on what a trust is. A trust is typically used by people to protect their assets and to also ensure that those assets can be used for multi-generations. So for instance, you set up a trust structure, you say, oh, I just want to set up this trust structure so that I don't get myself exposed to creditor risk. So you are taking a loan from a bank and the bank has access to all of your personal assets. They put a lien to say that if you don't pay back on this loan, I can come and collect all of your personal assets. You can do some protection through a trust. And what the trust effectively does is that it will split the ownership and say, legal title for these assets is no longer with me as an individual, Moyo or Esiri. It is now Mariah or Esiri. It is now with the trustee. But the beneficial title is still with me. So all the benefits that come from any investment that that trust arrangement or that asset generates is still for me. So I get some distribution from the trust. But what I've effectively done with that trust arrangement is I've split the title. Now, when it comes to whether or not banks or a creditor can seize assets, they have a long conversation to have because the legal title is now with someone else. And you might have seen structures like that with some of our footballers or even musicians, where they have the title in their assets, their royalties, or even their network or assets is held by their mom or held by their dad. The mom or the dad in that instance is your trustee. So what this act is trying to say is we must look at that structure. We must identify who has the control. Is it the individual who set up the trust, or is it the trustee that is just making decisions for that individual? Because we believe that the trustee is empowered enough, the trustee has the capacity to deliver more returns on that asset. So given the level of control, it will then determine where that trust structure is resident. So if you had a scenario where, oh, Esiri set up the trust, but Esiri is still the one making decisions on how we invest capital and how we allocate it to Esiri's children, in form of the distributions. Wherever Esiri is resident, that trust structure will take up the residence of Esiri. So if Esiri is resident in Nigeria, but you set up a trust structure in Cayman Islands, BVI, or UAE, or London, the trust becomes resident in Nigeria. And once it is resident in Nigeria, that trust will have to pay taxes on its worldwide income at the rate applicable to Esiri as an individual. However, if that trust structure, which is offshore, is controlled by the trustee, which is a foreigner, then Nigeria doesn't have access to tax all of that foreign trust earnings. They would only tax the earnings attributable from Nigeria. On top of that as well, one must then look at the distributions that come from the trust. The intent is not to have double taxation with a trust structure, because the truth is that most times when trusts hold assets, like we had explained before, they hold it and manage it on behalf of someone else. So when you look at a trustee's books, you see something like assets under management. The trustee by itself then gets a fee for doing its work. So the trustee will not pay taxes on the assets under management. They will pay taxes on their fee. And the assets under management, when they generate income, they distribute them to the beneficiaries. The beneficiaries by themselves will now have to account for taxes on what has been distributed to them. Or if the trustee still has control, the trustee will account for the taxes on behalf of those beneficiaries. So in the trust game, it has a lot to do with control, who exercises the control, where that person is resident, and once you determine those three, you can then identify where the taxes will go to. Obviously, the next step is then to say we don't want any double taxation. So it's possible that you have to pay taxes in Nigeria, but also have to pay taxes in another jurisdiction. If that is the case, you must then look at what relief is available to claim. And some of the countries have tax treaties with Nigeria, so you can claim a relief under the double tax treaty. If there's no treaty with Nigeria, Nigeria then has graciously said that they will give a unilateral relief. So they will give you a tax credit if you pay taxes elsewhere. So you then bring those taxes from elsewhere, offshore, and you use them to reduce the taxes due to the Nigerian government. So I'll stop there and hope it has answered the question you asked.
Thank you very much, Esiri, for the detailed response. So I'll come back now to you, sir.
Okay.
So this question is from a fixed income investor. It says, is interest earned on foreign equity, foreign currency, USD placements? So interest earned on USD placements, are they exempt from withholding tax under the new tax law? If yes, what are the new applicable tax implications on the interest earned by individual and corporate entities?
Just that. The answer is no.
Okay,
And it's so simple.
that's very...
Yes, under the old provision, yes, investment in, interest on foreign currency denominated accounts are exempt. Okay, and like I said earlier, that the main push for some of these changes that we're seeing is the fact that when we exempt some of this income from tax in Nigeria, if they are investment by companies that have holding company in jurisdictions and their turnover is a particular threshold, we're just ceding taxes to other countries. And so many of those things that we used to enjoy, this new law have removed,
Taking care of it.
not removed per se, at least brought in, ensure that those taxes
Are not being earned.
are payable to Nigeria. So foreign currency denominated accounts are no longer exempt from withholding tax. So they're applicable. So if there is interest on those deposits, there is 10% withholding tax. Okay, on them. And for a company, it is just an advance payment. So that income will form part of the income of the company and will be liable to tax. But if those deposits are for non-resident entities, then the withholding tax is taken as final. The same thing also applies to what we used to say that no deduction for interbank deposits, whether it is the DOM or Naira, that no longer apply. Interbank deposits are now subject to 10% withholding tax, like any other deposit. It's not that they are exempt before anyway. It's just that you are saying no source deduction. But now, since there is really no exemption, source deduction should apply. This is strictly talking about cash deposit now. And it's different from securities and all that.
Oh, okay. So follow up to that. Are capital gains from the sale of fixed income securities, are they taxable under the current law? And then how does it now apply to the new tax law?
Okay.
fixed income securities.
Okay, when you talk about fixed income securities, you're referring to bonds,
Yes.
treasury bills,
Yes.
certificates, notes, debenture here and there. Okay, yes, under the old provision, up to 2021 year end, most of these fixed income securities were exempt. One, bond, federal government bond, state government. I mean, state government bond was not really exempt, so federal government bond was exempt.
Exempt, yes.
So all of those bonds were actually exempt up to 2021, but from 2022, even before this new law, only federal government bonds remained exempted. Okay, but with the, I mean, up to that point, and therefore, from 22 to 25, deduction at source was required by the person making such payment, except interest on federal government bond. Okay? Which means treasury bill withholding tax was applicable.
Yes, yes.
It used to be exempt up to 21. Corporate bond was exempt up to 2021, now applicable. State government bond was exempt up to 2021, now applicable. But with the new law coming in 2026, from 1st of January, both federal and state government bonds are now the only exemption that remains. So interest on state government bond, Lagos State, any state, bonds, the interest are exempt from source deduction. We are not supposed to deduct any tax from them. But any other fixed income securities, the only controversy around now is who should deduct,
Yes.
not whether they are liable to source deduction.
There will be deduction.
The deduction must happen. Okay?
Okay.
The question is it the debt management office? Is it CBN? Is it the
asset
custodian?
manager?
Is it the bank? Is it the maritime security and all that? That is the only question that people are asking. And I mean, for me, I think it's a little bit straightforward.
So
to come to that.
who should make the deduction?
Okay, so the law says source deduction.
Yes.
So it is the person paying to the beneficiary that should deduct. Okay, and I will explain. Some of these investments are done through portfolio investors as well. Some of them are funds, collated by security companies or what we call them, asset management companies,
Asset managers,
and
yes.
then buy on behalf
Of the
of
clients.
a number of investors, including individuals,
Yes.
including companies, including trust and all that, including insurance companies. All right. So when this interest, particularly let's take treasury bill, okay, I mean, you say it is the debt management office. Debt management office may not have the details of the original of the eventual beneficiaries. Okay, and so if you say debt management office should just deduct 10%, you know that 10% is applicable. Why are you pushing us? Why are you pushing it to the banks who are making payment? The debt management office will not know the beneficiaries,
They won't have the
and they
tax
will not know whether to
IDs.
pay to state or to federal, and those are constitutional issues. And that is why it has to be the person that have the identity of the actual investors, whether they are individuals, it should be paid to the state. They will know the state to pay to. You cannot just go and pay to Lagos State. Whether if they are company, then it goes to FRS. So that is where it gets a little bit clearer. I know banks want to push away. We are just agents. We are not the one, but we are the one that is paying into somebody's account, really. And you should know the identity of the person you are paying, the coupon that is coming to. I mean, even if it is one that is traded along the line, as they are being traded, if you hold it for a particular period of time, maybe for 10 out of 12 months, for 6 months, all right, at that point, interest has accrued.
Yes.
And you that invested, you will definitely want
Yes,
the interest.
yes.
And so at that point that is going to be paid to you, that is selling it, there's an interest element, which is called cum interest to some extent. And whoever is paying you should know your identity and whether you are an individual and where you are resident. If you're a company, straight to the Federal Inland Revenue Service. Okay, so it is difficult to say that the banks making the payment or the stockbroking firm making the payment,
Is saddled with
if it is the custodian that is
responsibility.
making the payment, you know the identity of the beneficiary.
So it means that the taxpayer ID now comes into place.
Yes.
At the point of making that investment, the investors would then be obligated to provide.
Under the new law,
Yes.
every insurance company, banks, financial institution must request for taxpayers' identification number. For new investors or new account holders and existing one if they don't have. And that is another big task, but the Joint Revenue Board that is coming up, starting from January, they already are in existence as Joint Tax Board. They are working with NIPSI, so that the NIN represents the main base
Okay.
for determining the tax identification number. And they are also working to make it possible for the banks, the security companies to be able to access a portal as soon as you ask a taxpayer, your client. Most people will not, be agitated if you ask for their NIN number.
Yes.
But if you ask for BVN or you ask for
start
tax
to ask
identification
why.
number, they begin to ask you questions. Are you trying to report me to the
Yes.
tax authority or something like that? But their NIN is the base. And if you have the NIN, it can be uploaded through a portal that the Joint Revenue Board is working on. I don't have the details, but that is what they said they are working on,
Oh,
such that even banks can access the portal and generate
Get
your
information from there.
tax identification number for you. And that resolved the problem around banks having to run up and down looking for investors or taxpayers' tax identification number.
So now I want to take it now to our clients that are personal, right? Filing their personal income tax. That's their individual responsibility. How is there like a portal where they can go to file? I know that I think some time ago Lagos State came out with a portal where you can file your, but outside of Lagos State, is there a structure? Is there a portal where individuals can now, with this new tax reform, I know everyone has to file their tax one way or the other. So is there a means, a channel for individuals to be able to file their personal income? And at what intervals are they required to file? Is it at the end of the year? Or can they file at different intervals, not waiting till the end of the year?
Okay, so when it comes to personal income tax,
Yes.
it is personal to the individual.
Yes.
And when you talk about being personal, it means it also depends on where you reside. Okay? And
yes.
so it is under the purview of the State Internal Revenue Board of the state where the person is resident. If you reside in Lagos, Lagos State has the e-tax system. Okay, you file your return online.
Yes.
They are even insisting that even if you are an employee and your employer file your return,
On your behalf.
okay, on your behalf, they expect that you take hold of your own tax, civic responsibility. And that is why they're insisting that every individual in Lagos must take their tax filing very seriously and file it individually through the e-tax system. If you are struggling with that, you can visit the Lagos State. They will guide you as to how you can get registered on the portal, and then you can file your return even from the comfort of your office. I file my own return fully. And so other states are also following that footstep.
Yes.
Other states are really not necessarily the same e-tax system.
We're trying
But
to
of course,
ensure that.
And again, through the Joint Revenue Board, they are working on having a unified tax identification number. But that does not mean that the old one no longer works. It is one that can be synchronized, with the one that they're working on. So individual will file their returns in the state where they are resident, and they file both the return is due, for individual by 31st of March each year, which means by 31st of March 2026, individual must file returns of their income in 2025. Okay, like that. Even though the employer,
Yes.
okay, are required to file by 31st of January to say that these are my employees, these are the income they earn, these are the taxes are deducted, these are the evidence that I have remitted to the state. That is the employer's responsibility under the payee scheme. But the individuals still have their own responsibility, particularly where your income is not strictly salary. You have rental income, you have interest income for individual. As soon as you have suffered your withholding tax, no longer liable to tax, dividend income, no longer liable to tax. But you can have capital gain as well. Or you can have gain that is exempt. You can still disclose, even though it's not taxable, as long as the threshold of 150 million and 10 million profit is not exceeded. You can still disclose and no tax will be applied, which means you are showing, and that will be reflected in your tax clearance. Okay? Let's stop there.
Thank you. Thank you very much. Let me just take one more question for a Siri, and we'll tidy up from here. A Siri, so now, what is the likely net effect, right, of this new tax reform on the purchasing power? We know that inflation already is impacting the purchasing power, but now that a lot of other sources of income are now being captured into the tax bucket, how much of an impact do you think that the common Nigerian is going to feel on their purchasing power under the new tax reform? Isiri?
Yeah. So I think that this question will be, the answer might be long drawn, because I don't think that you would feel or have the immediate effect as one would love to have in the short term. So the truth is that it will take time for things to settle in. But if we look at the big picture is, look, we desperately needed a tax reform to widen the tax net. The more we widen the tax net, the more revenues we generate locally with less dependence on revenues from external sale of our crude oil or even gas reserves. But more importantly, those tax revenues that we shored up will then hopefully repress the interest rates that we're suffering because we have to borrow funds basically to do a lot of infrastructural growth. And because of the time value of money, it has a direct impact on your interest. Those borrowing rates as well also go into the purchasing power in the sense of the inflation of your food basket. So all of the things that we buy, services, goods, they run on funds. Those funds are borrowed. The interest rate flows directly into the pricing of goods as well. The tax also has an impact on how goods are priced. And so when I was speaking around VAT, the big changes that we have in VAT, it's landmark. We didn't have the opportunity to recover some of those costs, at the taxpayer level because of the restriction on how you could claim impute VAT. That's one. But now that has been freed up. If that has been freed up, like I said before, the pricing strategies of the companies that we buy our goods and services from needs to also reflect that. And because of the competition in the lands in the market, you may find that companies respond to this by saying, what are those tax benefits I'm gaining from this reform? And how can I use that to instruct my pricing strategy so that in turn also affects the pricing of goods and in turn our inflation. Additionally, we have basic supplies now that are now identified as zero rated. That is huge. Identifying those as zero rated simply means that instead of us not charging VAT, in addition to us not charging VAT on those goods or on those supplies, we're able to get a refund from the system on the VAT that we suffered on the manufacturing of those goods. So like your processed bottled water, That bottled water is zero rated. The purchases, everything that went into producing that is going to be recovered from the government. So you have a 0% charge, you have a refund due to that company. Automatically, it has a direct impact on the pricing of the goods. But will that take effect immediately in the short run? Not likely. But we can see that over time, settling in and seeping in and saying that inflation should go down and interest rates should also go down. If we widen the tax net beyond what we have now, that also means that we're not relying on just a few percentage to pay taxes to shore up revenues required for infrastructural growth, to generate our IGR as well. So we now have a wider pool. Tax revenues go up internally, IGR goes up internally, and that puts a lot less exposure, or we have a lot less reduced exposure to external or global shocks. So I do see this in the positive light, but I think in terms of the play individually, every single person on this webinar, every single company that's represented needs to go in and, like you said, Morayo, identify those exceptions. What are those exceptions that can increase my bottom line? What are those exceptions that can make sure that I don't get exposed to the hidden cost of penalties and interest under the new regime? So you can make it what you want it to be, depending on how knowledgeable you get, but how practical you also get in terms of implementing those exceptions under the laws, and using also the benefit of tax advisors or professional advisors to make sure you get the upper hand here. So it's a game of chess. Your king is either going to fall, is either going to be captured, or you're going to stand winning. So choose the one that you want and let that play out for you in 2026 and beyond.
Thank you very much, Asiri. So essentially, get yourself a tax consultant that would help you understand the new tax reform in line with your income and see how you can maximize where the opportunities are, if I get Asiri correctly. So here I have a question from the general audience, sir. This is for you.
Okay.
So this person says that I am a retiree and I'm investing my income from my salary. Am I still going to pay tax on my investments as a retiree?
Okay, that's the question.
Yes.
Okay, so
Oh, and then are my dividends going to be taxed outside of the capital gains tax?
okay. So as a retiree, I mean, the retirement income, depending on what it is, may be taxed and may not be taxable. I mean, your gratuity is not taxable, your pension after retirement is not taxable. But of course, depending on what you do with the money.
Okay.
So if you invest your retirement fund, I mean, even if you are paid compensation for leaving the business, I mean, for leaving the company as an employee, the compensation will not be taxed if it is not above 50 million. It is only after 50 million that capital gains tax can apply. But after all of that, and you have fund to invest, depending on what you invest in, that is a new source of income entirely.
To be
So
subjected
if
to
you
the
place
tax.
the money in fixed deposit and you are earning interest, the withholding tax at 10% will be deducted before the interest is credited to you. If you use the money to invest in the short-term security or long-term security, treasury bill, bonds, and all that, depending on whether the bond, I mean, if you invest in state government or federal government bond, no tax, but treasury bill, withholding tax will still be deducted. If you use the money to buy shares and you are just collecting your dividend, okay, the dividend, before it is paid to you, suffer withholding tax. There is no capital gain on dividend. Like the guys, there's no capital gain on dividend
okay.
until you sell your shares or investment in the company that is generating the dividend. Again, if you earn your 90%, which is of your dividend,
yes.
because 10% has been taken away, and you invest in fixed deposit again, that is another source.
How about mutual funds? Are mutual funds going to be taxed in the new tax reform?
Syria has already explained there's no much difference between a trust and a mutual fund per se. Okay, so if you earn income, there are some, we have the real estate investment trust, we have those ones have special dispensation.
Okay.
But other than that, there are no specific exemption for mutual
Everything
funds
goes in.
in the law. All right. So as long as you generate new fund and new income from old income, the new income is a new source, and then we start looking at that new source to ascertain whether it's a new source that is taxable or it is not taxable. If it is truly taxable, whether you are retired or not, you pay tax.
In the event where you suffer some loss in your investments, so can that loss be deductible from your gains?
Of course. So if you make a loss under the new dispensation
Yes.
within a particular year,
Yes.
and then you make gain
Yes.
on other transactions, the loss can be set off against the gain.
Okay.
Okay. And if at the end of the year you make more loss than the gain, the loss can be available for subsequent year
Oh, okay.
until you recover the loss. So those are provisions are there. It's not just negative in terms of capital gain.
It's not.
Right,
It's not
but-
the end.
So what I will just add is the fact that there has been agitation as to as soon as the new law kicks in, people's bank account becomes income. No, it does not work like that. I mean, as again, individuals are liable to tax to the state. So it is the state that has responsibility to ascertain individual tax liability. Okay? Yes, they have different way of ascertaining whether you have complied with the law or not. Maybe looking at the type of house and the land use charge you are paying, the vehicle that you are registering with the vehicle license authority. Okay? And all of those are indication of your lifestyle. Then they can start looking at that if they truly want to do it, comparing that with the type of tax return you have filed, and then they can question. And then it is for your it is for you to answer those questions. Those funds in your account may be loan. Okay, if they are actually gifts are not taxable in Nigeria today. If you receive gift, it's not taxable. It's not liable to capital gains tax. Gift is like it's like in other climes they treat it like an inheritance. An inheritance in Nigeria today is zero tax. Okay, it's capital transfer which has been abolished in Nigeria. So if you receive gift, it's not taxable. So you must be able to explain how the fund in your account has been generated.
So it should come with narration. If there's a narration to the inflow that says gift.
So, the general fear is that, maybe the tax authorities are actually viewing my account. Yes, they can be viewing your account, but you must have explanation for whatever is in your account. All they want to know is it an income? Have you paid tax on it? If it is not income, it's not taxable. If it is a borrowing from friend that you want to do business, it's not taxable. But that does not mean that you should allow your account to not be rude for distributing money to your family members. Okay? So that you can reduce the type of question they will be asking you.
Okay.
All right? But that does not mean they will just tax it automatically. No.
They'll ask you questions.
There will be questions.
Okay. I want to ask you,
answer. Yes.
Before you give us your final comments, sir, I want to ask you a question. You mentioned inheritance in your just concluded explanation. So, life insurance, beneficiaries of a life insurance policy, would they be taxed? Would that life insurance be taxed on the beneficiaries?
Okay, so when you say life insurance, under the Capital Gains Tax Act, the current law, proceeds of life policy are exempt, except you are the original beneficiary.
Policy owner. Okay.
Not policy owner, original beneficiary. If you have life policy, the person invested, that is life until you die.
Yes.
Okay? Except it's an endowment.
Okay. Oh.
Okay, which you can collect before you die. But for a life policy, you are not the beneficiary. So the original beneficiary is not liable to tax. Okay, but if the original beneficiary decides to There's
So
another
that's where the
conversation.
tax will come into
So
play.
for life policy
Is exempt.
is exempt from capital gain,
All right.
and that provision still sustained
All
in
right.
the new law.
Thank you very much, Mr. Albert. Thank you very much, Esiri. So we're tidying up this conversation now, and I'm just going to take final comments in 1 minute. Esiri, help us wrap up your conversation with us. Where should the common man be looking at? In 1 minute, Esiri. Thank you.
Yeah, so I think we've said a lot already on this conversation. Everyone on the call just needs to, look at this with wider lens, yeah? And hopefully this conversation has helped to reduce some of the anxiety, because I think a lot of people hear the word tax reform and everyone is scared. But the truth is, this is really for the development of our nation. And there definitely might be instances where things may look unfair, which is where you then need to defend your position and say, on this particular circumstance, it should be looked at this way because of so and so and so. And this is also where the power of the tax ombuds comes in, because there's a tax ombuds that is to be created under the new law that will advocate for the rights of taxpayers. So again, it gives us an opportunity to be not only knowledgeable, but also to defend our own turf. And the only way you can do that is through active communication. There are opportunities definitely to save you in terms of money and overpaying taxes, but you need to embrace that as well. You need to keep your books in order and make sure that when the time comes for defending that position, you have substantial information that can be provided. And that journey starts now. So thank you, Mary Stem, for putting this together. I hope this has been very useful. And thank you for having me as well to share.
Thank you very much, Esiri, once again. So I'm going to bring it home to you, sir.
Okay.
Your final comments to our audience.
Okay, I think from looking at the new law,
Yes.
the most critical thing for businesses is record keeping.
Yes.
A lot of people are afraid, and they may not even making profit. And tax is on profit,
Yes.
not on income per se. Except those that, even if you are a salary earner, if you have your documentation, there's a small provision that says that if you are able to provide evidence that you have paid rent, you will get a relief of 500.
Yes.
That is part of documentation. So enterprises, are worried that they are going to be taxed like a company. No, companies, even as an enterprise, you are going to be taxed as an individual. And if you run a business, regardless of the turnover, keep your record. Whatever you are selling, ensure you have the record. Don't mix up businesses in one account and then including your family distribution. They are in one account and you are unable to explain. Keep proper record. As a sole trader, keep proper record. Your turnover, make sure all the expenses. Some of us don't even have record of what we are selling. They only see the turnover. Keep record of what you are selling, and you are allowed to deduct it. If you receive rental income, keep expenses of repair to the property, including claiming capital allowance on the cost of constructing the building. A lot of us don't keep those records. So for me, to be able to face the tax authority and even claim loss where you have made loss, because some people are making losses, they are afraid. Okay, and when you make loss this year, you can carry it to the following year until the loss is fully utilized. So let's cultivate the habit of keeping record of our income, of our expenses, and try to file it. Even you don't need consultant as an individual most times to go to Lagos State and say, this is what I've sold, see my account. In fact, some people are struggling and they are still afraid. Some people are below the threshold and they think that maybe tax authority will just look at their account. A lot of people are setting up corporate entity. They are quickly incorporated. They say, individuals are going to be taxed. Instead of just leaving their income where it is. Today, now, I can tell you that it is better to hold your income in your name than to put it in a company where you pay corporate tax of 30% if your turnover is above 100 million. And then in addition, you pay development levy of 4%, all right? And all the other things that comes with company.
incorporation.
But as an individual, the maximum tax rate is 25%. And you are still eligible to take all those deductions, the expenses, in addition to relief, pension contribution, you get relief, NHF, you get relief, health, you get relief, interest on your mortgage loan for your own personal house that you are living in, you get deduction.
Oh, wow.
So all of those, for me, keep your money in your personal name, and then it's safer. You have dividends from people receive their dividends instead of receiving it in their personal name, they receive in a company. The company will now be subject to tax on the interest generated from that placement at the rate of 30%.
And
But
they could
if
have
you
just
receive such interest in your name, it's frank investment. The banks take 10%, and that is final.
Oh, wow.
So I think a lot of us that are on the call should take note of all of these, and really there's nothing to fear. There are more benefits in this law than the other side of it.
Thank you very much. Thank you so much for your time. We know that your schedule is really packed. We appreciate you making our time to educate our clients and our audience.
Pleasure is mine.
And from this, it's a wrap. And we're going to have our closing remarks from our Group Managing Director, Sulaiman Adedokun. Over to you, Sulaiman.
Thank you very much, Murayo. I would like to first appreciate and thank our clients, corporate and individual, for attending and participating in this session. Our objective is to educate, is to inform. And after that, I would also like to appreciate our guest speakers. First, Mr. Albert Folonshaw, managing consultant with Pedable, and also Mrs. Esiri, the partner with PwC, for the depth of their presentation. It's so much insightful. As an organization, our why, our most transformative purpose is to advance the financial well-being of our clients. There is no doubt that taxation, if not properly managed, erode value for clients. And that is why we are so particular about this particular topic and how it affects us as clients generally, as investors generally. What do we need to do? Since tax impacts the financial well-being, if not managed, what you get is reduction in value. And that is not our objective. We want to advance the financial well-being of our clients, meaning particularly there's a need for investment management, meaning that in particular there is a need for strategy, investment strategy, tax strategy. My understanding is that strategy involves 3 key areas, especially first allocation acumen, that is the insight. The second one is the allocation, that is how do you allocate the resources. And the last one is action. What we are doing today in fulfilling our brand promise is to provide up-to-date market information, is to provide insight, getting the speakers, the guest speakers to provide insight, the expert on this particular area to provide insight to our clients. This insight is fundamental and is key in taking the next step of allocating. When it comes to allocation, the resources, the portfolios, those are our wealth, are assets. How do we manage? How do we bring everything together in a way that we optimize value? How do we manage our tax in a way that we don't pay too much? We are not evading, but we are managing the tax as a way of enhancing the value, as a way of enhancing our financial well-being. And action is the last one on investment strategy. And that action is what we need to take, beginning from now till we enter 2026. I mean, when the tax administration commences. So I would like to appreciate all of us for taking our time to engage, to participate in this session, in this webinar. It is so much needed, and we are proud as an organization to provide this information. I will encourage our clients to take this seriously because we don't want to see the disruption in value. We want to see increment, increase, enhancement, advancement in their financial well-being. And we believe that these sessions particularly will take us to the next level and will make it easy for us to achieve that objective. We are so much available with our partners to coordinate efforts needed to advance that financial well-being in tax planning and investment management. We are so much available to advance that financial well-being for our clients. Thank you also to the organizers, Murayo and the colleagues, Meristem, for putting this together. We are so proud of all of you for what you have done for our clients. Thank you.